Now, moving on, India is emerging as the top private markets destination in Asia Pacific as investors look beyond China for long-term growth. That's according to a survey by McKinsey & Company and the Indian Venture and Alternative Capital Association. About 30%, 31% of global limited partners ranked India as their first choice, while 76% placed it in their top three, with more than half planning to increase allocations to India-focused funds. Private equity and venture capital deal value in India has climbed to 207 billion between 2021 and 25, more than 1.5 times higher than the previous 5-year period, with exits doubling to about 120 billion. To talk about that and more, we have Aakash Desai. He's the CIO, Head of Private Credit at 360 ONE Asset. Really appreciate you joining us, Aakash. This is something we've been looking forward to doing for quite some time. I just want to start by getting your first impression. How do you really calculate the impact of Iran on India's private credit space? Can you quantify the impact at this stage of cost-push inflation from the impact of volatile movement of crude prices on India's private credit portfolio?
Hi, thank you for having me. Look, the Iran situation is something we're monitoring super closely. To give you some context, every $10 rise in oil prices has about a 30 to 35 basis points impact on CPI. That's something we're watching super closely. Although a lot of industries that will get directly impacted will be fertilizer, oil and gas. But a lot of the mainstay of Indian economy, healthcare, pharma, renewables, will get impacted as a lag effect. And that's something we're watching super closely depending upon how long prices stay higher.
All right. How is 360 ONE thinking about its credit strategy? And I say this because we're trying to understand the portfolio construction themes you're watching. What are you avoiding? What are your first principles? How can somebody have first principles in this dynamically fast evolving world?
Look, I mean, we've always built our credit business on the core theme of looking at performing credit. Our essential business is built around the first principles of looking at strong operating unlevered companies who need growth capital solutions. And in that context, we've always stayed away from distressed rescue capital situations. And if I were to break it down a little bit more, the 3 or 4 pillars of our credit strategy are built around our own origination strength. A proprietary origination gives us control over outcomes. It helps us give capital at scale and be a full stack solution provider. Our robust diligence, I think that's the bedrock of our investing has always been. Third has been our ability to provide a full stack solution with covenants, protections, downside protections, etc., which has really been the reason our portfolio has done extremely well, even in these volatile times. And I think the fourth is just being able to be senior in the cap structure, right? If you look at these classical investing principles, I think we've been able to build a really solid credit portfolio over the last 3 to 4 years.
I understand. It's interesting to note at this point, while we have indicated that India has great promise, compared with the rest of the world, the private credit market in India is small, with estimated assets under management of about 25 billion to about 30 billion as of March 31, 2025, representing about 0.6% of India's GDP and 1.2% of the overall corporate lending sector. Now, this is also against a global market of $3.5 trillion. Now, APAC's share of global private credit is just 6.7%, despite producing 46% of global GDP. So how much of all of this, these numbers, are a sign of structural constraints in India? And can they be overcome to grab the gap opportunity?
It's a great question. I mean, we've always believed that in a growth market, flexible, non-dilutive capital solutions will always have demand. And if you look at India where it stands today, we are seeing a trifecta of factors: massive growth opportunities domestically, domestic M&A and consolidation, and then a large government capex plan to spend over $900 billion in sectors such as infra, healthcare, renewables, and that manufacturing. I mean, we've seen so many PLI schemes boost manufacturing in India. We believe all of these will drive the demand for flexible capital solutions. And if one can create a quality portfolio and a full stack solution, the opportunity set is really very, very large. We're super buoyed by the fact that 3 things are playing out in India, right? I've talked about demand. And really, credit is at an inflection point in India where the runway, as you talked about, is phenomenal. I mean, if you look at most Western economies, private credit as a percentage of GDP is between 6 and 7%. In context, India is just 0.6%, right? And with a growing GDP base that provides a massive runway for credit to be deployed in India, that demand is essentially coming because of three factors, right? One, we're seeing growth. And so every industry, company, promoter looking to increase capital formation and looking for growth capital requires a capital solution that we can provide. Second, increased adoption. I mean, the average EBITDA of companies we've deployed capital in has gone up over the years, right? So no longer are we looking at mid-cap companies alone. We're looking at mid to large-cap companies, understanding the value that private credit provides in terms of their growth, their M&A, and these are solutions that only flexible capital providers can give them. And the third, I think, is given India's improved regulatory framework with IBC coming into play in 2019 and the IBC 2.0, which is just on the anvil, it's provided lenders, both domestic and global, with a lot of credit comfort. And we are seeing capital flows come into India on the back of this renewed regulatory comfort and improving enforcement landscape in India. So we think that the opportunity set is extremely large. The supply of capital has so far been limited, and hence a large white space exists to build a quality private credit business in India.
Okay, very interesting. I want to talk about IBC because you mentioned it. It is a bit of a concern, and I want to bring up a particular point regarding this. It's quite interesting to note that the insolvency and bankruptcy code, which we were referring to as IBC for our viewers, has improved recovery mechanisms. You mentioned that, fine. But resolution timelines are still averaging 1 to 2 years and can stretch longer for certain complex cases. In a concentrated default scenario, the system could get clogged, as we have seen culturally in India. So where does the balance between, really lie between strengths and weaknesses?
I mean, it's a great question again. Look, I mean, to give you some context of the industry, and then I'll talk more about IBC, right? I mean, banking system in India or creditor capital in India has been at its best ever point. 2017-18 non-performing loans, if I remember correctly, was between 10 to 11% of the entire banking assets. Today, that's sub 2%, right? And really, if you look at average recovery rates through IBC, they've gone up from 24, 25 to almost 68%. Yes, you're right. Recovery times are still between 1 to 2 years. But if you look at structurally where they're moving, the trajectory of enforcement times has been very encouraging. They used to be 3 and 4 years, right? So we're nowhere near where we should be from a enforcement timeline perspective, but the direction is going in the right way. And I think the threat of IBC, right, or the enforcement now of standardized jurisprudence and clear practice of the law being applied is enough to create good borrower behavior. And so we look for companies where we know there is integrity, governance, and essentially the threat of IBC is large enough. And now promoters are afraid of actually losing control of companies, which wasn't the case maybe 10 years back, right? That itself has been a massive uptick in the underlying performance of credit portfolios. We are seeing that in our portfolio. We've deployed over $2.2 billion in capital and not lost a single dime, right? And that really is what is improving the quality of portfolios and improving the creditor comfort and driving capital flows to India, right? From a corporate issuer standpoint, when corporates have delevered substantially, if you look at leverage levels in maybe the Nifty 500, they've dropped almost 60% from where they used to be 5 years ago, right? So all in all, essentially, I would say from a strength perspective, you've got a very healthy corporate balance sheet in sort of corporate India. You've got banks and flexible capital providers ready to provide capital to look at growth. And you've got an underlying economy which is growing at between 6 and 7%, where differentiated pools of capital will all have a place, right? So all in all, we're seeing a fairly attractive next 5 to 10 years and a transformational sort of once in a generation opportunity to deploy capital in more core manufacturing sectors, right? So if you look at renewables, right, pharma, right, infra, these are all sectors which are capital consumers and will need capital from all sources.
Okay, let's talk about the cyclical risk part, because private credit investments in India totaled 12.4 billion in 2025, representing about a 35% year-on-year increase compared with 2024, according to the EY private credit report. But the cyclical risk, perhaps real, because what's happening is that bank credit growth has firmed to about 12% year-on-year. PSBs are aggressively pricing retail, and NBFCs are expanding at 15 to 17%, last numbers, of course. More competition is coming. And does that really narrow the opportunity set when you think about perhaps a structural shift that can sustain when banks get aggressive again? That's the question.
I mean, it's something we look at every day. If you look at it from our standpoint or any private credit manager, I mean, our essential growth is coming from non-plain vanilla, non-conventional capital asks. So as long as we look at structuring as a massive solution, we look at providing the full-scale capital stack and look at really inorganic and growth opportunities. There is enough to play for everyone. From where the banks are sitting today, if you look at the broad capex outlay, right? We're talking about a $900 billion to $1 trillion capex program. Let's say even 70% of that comes from banks. The rest 30% will need to be provided from some capital solution. Either it can come from the public markets or private markets, right? So we're seeing unprecedented growth in the demand for capital. And because the capital's ask that we solve for is extremely niche, extremely nuanced, we still think there is a very large growth runway despite banks growing and NBFCs growing. And if you look at the average profile of companies, right, a lot of these companies, the large listed players will continue to go to banks. And with the recent easing of M&A regulations, we think a lot of the large listed conglomerates acquiring growth or acquiring new companies will always go to the banks. But there is a very large mid-market segment. I mean, the last number we looked at is about 125,000 companies that form about 20 to 30% of GDP that are above investment grade rating, right? All of these either don't have access to capital from banks or don't have the solution orientation from their capital providers. And that's what we're looking to solve.
All right, very interesting. I want to just right now ask you one final question because we're completely out of time. Can you give us a closer look at the profile of companies where the opportunity really lies? Just a closer look, and also explain, because my understanding is that you're not really looking at pre-market companies like startups and late-stage companies. So what's keeping you out of them?
So we've defined our sandbox exceptionally well very early on, right? So we said we will look at industrial businesses who are looking to grow, where there's positive cash flow, where there's assets to collateralize. We've avoided, cash flow, cash flow light industries. So the likes of SaaS, fintech, IT, EPC companies are something we've avoided, given the loss given default could be high in India, right? So our target zone really helps us narrow in on companies which are what we call old economy. So manufacturing, pharma, hotels, hospitals and healthcare, renewables, transportation. These are economies, these are industries which will always need capital, where we're able to really have the optimal credit structure built, where we can get collateral, cash flow, strong covenants. I mean, our entire credit diligence and monitoring is built on the right pack of financial covenants, operating covenants, etc., with full promoter recourse, right? So we've been able to really create a right to win within these 4 or 5 industries, and that's where you'll see a lot of our portfolio being deployed at.
Okay, Aakash Desai from 360 One Asset, we really appreciate all of those insights. It's a very promising sector to watch out for, and I'm sure we'll come back to you when there are many more developments, as we can expect. Now, Indian markets have joined the trading day. We'll look at some movers in Mumbai after a very quick break. We're back in 2. Don't go anywhere.